Good morning and welcome back to the Money Advantage podcast. Today we are talking about the term rider on whole life insurance policies. Now, before you tune out, if you have no idea what I'm talking about, we're going to explain to you what this means and why it matters and what you should be looking at with the pros and cons of the different kinds of term riders that can be on a whole life insurance policy. Now, Bruce, thanks for joining me for this conversation today. I'm going to go ahead and just paint a really quick picture for somebody who's coming in and saying, what are you talking about? We're talking about whole life insurance, which is a type of insurance that builds not only the death benefit, that has a death benefit, that has premiums you pay in, and also has the cash value, which is like equity built inside of the policy over time that you can access and use. We talk a lot about infinite banking and we talk about whole life insurance. And the reason we connect those two is that infinite banking is a process of storing capital and being able to access and use capital. Whole life insurance happens to do that process and that strategy really well. And so within a whole life insurance policy, you have premium that you're paying, you have a death benefit, you have this growing cash value, and often within that contract, which is an agreement between you and the insurance company, you're transferring risk to the insurance company, there is a term component, a short time frame life insurance policy that is inside of your whole life insurance policy. So Bruce, I'm going to turn it over to you with that context and that explanation. Really, we want to dive into what is the term rider, why is it there, and then why would you look at a level term versus a blended term, and what does that mean, and why is one better than the other?
Yeah. So I think in order to do this, let's just back up just a little bit. And the original whole life insurance was often called ordinary life at the time. And so what it was trying to do was actually provide a place for money and protection over a person's whole life. And Nelson Nash used to say that that doesn't mean every other type of insurance is evil, because Nelson used to say the best type of insurance is the one that's in place when you die, because that's the most important thing. But whole life insurance was actually being used, as we talked about in other episodes, a form of it for several hundred years. And then it wasn't until the early 80s where we had massive inflation here in the United States. And when we had massive inflation, people started using loan provisions and the structure of the contracts to their advantage, where they would actually set up a whole life insurance policy. There was no real what they call corridors or ratios between the cash value and the death benefit. So they might set up a really little death benefit and put a whole lot of money in it. Why? Because dividends were very high, because interest rates were very high. And why would they do that? Because they could actually access this money tax free. It would grow tax deferred and they could access it tax free. It was wonderful. But then Congress came along and said, wait a minute, this is not really why we made this grow tax free and access, or excuse me, tax deferred and access tax free. We did it to incent people to actually protect their families so that they didn't have to come to the state and get welfare type situations if somebody prematurely died. And so they put in laws from DEFRA, TEFRA, and TAMRA, and these were different guidelines and tests that they ultimately deemed the modified endowment contract. So you do not want a policy, which is a contract, to actually become a modified endowment contract if you want to actually access the cash value while you're still alive. So there are many insurance policies that are modified endowment contract, which simply means you cannot access the policy, even through a loan, if it does not first follow a 1 year guideline and a 7 year guideline. And these guidelines
So
for
Bruce,
this for simpli-
it's not
go
that you
ahead.
can't access the cash value. It's that you can't access it tax free. Correct?
Correct.
Okay.
Correct. Yeah, I'm sorry if I didn't make that clear. You can access it, but you have to. It's just like any other place that you would put money in. It would grow tax deferred if you access it tax free, or excuse me, if you access it and it's a modified endowment contract, you have to pay taxes on it, and you have to pay penalties if you're not 59 and a half because it's technically tax deferred, just like the tax deferred rules. And so then people started saying, well, what are these corridors? And it's a very complicated thing that the Treasury Department and the insurance companies know. But basically, there are a ratio of the insurance has to be a lot higher in 1 year and 7 years over a 7 year period than it was. I often say it's like just flipping it. And I'll just use this as an example. It used to be they would do a $5,000 death benefit and put $100,000 in it, and it would grow tax deferred and access it tax free. And they came about with the modified endowment contract rules and kind of flipped it. If you want put $5,000 in, you need $100,000 of life insurance. That's way more complicated than that, but for the sake of the podcast, the sake of looking on YouTube, that is how it works. And so what ended up happening then is you have to have a certain amount of life insurance in 1 year and for 7 years, and any what's called a material change. Now, a material change may be how much premium you put in. A material change may be a drop in the death benefit because the term life is no longer around. So typically with insurance companies now, what you can do is you can add term insurance for a certain amount of term, just like it refers to, and it eventually will not continue without an increase in premium. Then the increase in premiums are astronomical.
So what you're
So
saying,
there,
Bruce, is not a term policy outside of your whole life insurance policy. What you're saying is that inside the whole life insurance policy, you're paying your base premium, you're paying your paid up additions premium, you're paying your term premium. There's all these three different components of premium that are going into your whole life insurance contract to make it the most efficient possible, ideally with the term to bump up that death benefit to the point where you're not going to mech the policy, or you're not going to bump it over into the mech status because you're pushing the death benefit high enough to be able to put in your ideal base and PUA premiums.
correct. If it was only a base premium or what was called ordinary life, just a normal policy, then you would never mech the policy because that's already figured. The ratio is already figured. It comes in where if you want to add additional paid up insurance that is optional and you can add it every year or you can add it once a year or once every 10 years, once every other year, however you want to structure it. There brings flexibility in it. But in order to bring flexibility, the MEC rules say you have to have additional insurance. Well, if you try to do that with permanent insurance, it becomes very, very expensive to add it. So one way you can do it is add what's called a term rider, where it's just going to be a option on the contract. And if you add it, now you can actually do more paid up additions with the policy. In other words, you can decide when you're going to add additional death benefit. You can decide if you're going to add additional premium. And that additional premium builds up the cash value a lot more quickly because it's a one-time payment. So
The
you
PUAs
get a
are.
one-time the PUA is one-time payment. Now,
Actually, Bruce, I want to comment one thing real quick here. So the question then comes in, we've got this term rider inside my whole life insurance policy. Now, term is what it sounds like for a specific period of time, which means you have options within that. You have, well, we could add a 10-year term rider into this policy. And then that premium would be lower for the term insurance, or you could add, sometimes some contracts will allow for maybe a 30-year term rider. And because that's a longer time period of the term insurance cost is a little bit higher. So the question then comes down to, well, what is this difference between level term and this annually
Blended.
renewable term or blended term? Yes.
Yeah. So so the first my recollection, the first time that this did it, they actually added 1 year renewable term to the contract. So they said, okay, at age 35, if you want to put in more PUAs, then there's going to be a term amount that you have to pay for. And that amount will be whatever it costs for a 35-year-old for that amount of term. The next year, it would be for a 36-year-old. Guess what happens to the premium? It goes up because it's 1 year and you're 1 year closer to mortality, so on and so forth. You get to 46 years old, it's going to be a lot more expensive than it was at 35. And so that term cost would increase along the way. The way the company then said, well, the way we're going to handle this, these companies said, is we're going to buy more paid up additions, not only with additional premium that we're going to pay, but the dividends are going to buy more paid up additions, which will then give you more death benefit. And if it gives you more death benefit, then we can reduce the cost of the term. So even though the rate of the term is going up, we're going to reduce the volume that is needed to pass the 7-pay test. And thus, things will be great. Now,
Because
when you do
essentially what
that,
you're saying is at some point, the base and PUA contract, ideally the PUA contract is going to push the death benefit higher, overcoming the need for the term to push that death benefit higher. That's what you're saying, right? I don't know if I said that clearly.
well, let's just make sure you did, but I don't think that maybe the listeners will understand. In that situation, the death benefit stays constant because you're replacing the term amount of that contract every year with additional paid up insurance. So you're reducing the term, so the death benefit
Got it.
has to remain constant.
Got it.
Okay. Now, one of the ways they do this though is they will stretch this term out to about 35 years. And so what they're doing is this term cost is coming down every year because it's getting smaller and smaller. So think of it doing this. That's the idea in the contract. Okay. At the same time, this is getting smaller and smaller in order to satisfy the MEC test, the amount of insurance you're buying with the PUAs gets bigger and bigger in proportion so that they match. And so the death benefit stays the same.
Got it.
The problem with this is it's confusing to understand. And at the very beginning of the illustration, they're presuming that dividends are going to stay the same for the history of the contract because they don't know what the dividends are going to be in the future. So they're projecting. What happens in a lower interest rate environment, though, now is the dividends are going to be smaller than what's anticipated, and it's going to buy less paid up additional insurance. So that original term cost is not going to be bought out. It's actually going to stay the same. And guess what? That wasn't figured in the original illustration. So now that original illustration has two things that are happening. The dividends are not as great as they said it was going to be, and they have additional cost. So there's only a couple of things can happen. One is you have to put more premium in to offset the cash value that you want at the very beginning, or you have less cash value. Okay, so
Neither of
my
which really reflect well on the guarantees of whole life insurance.
correct. And I think it's harder to understand, and the costs are on for a long period of time. Compare and contrast that to a traditional amount of term, whether it's 7 years, 10 years, 20 years, or 30 years. The price is set for those periods. 7 years, it's never going to change. 10 years, it's never going to change. 20 years, it's never going to change. 30 years, it's never going to change. So the actuaries, even though it's not 100% guaranteed, the illustration, what is guaranteed is the cost of the term over that time period.
Mm-hmm.
What also is guaranteed is how much PUAs you can put in. It's not guaranteed how much dividends are going to pay, but the dividends are not figured in the illustration to buy out the term. So it's a lot closer to reality than it would be the other way. The problem I'm also seeing in the industry right now is people think, well, if I'm doing this, setting up this whole life insurance to actually implement the process of infinite banking, I want to get as much cash value early on. So I'm gonna put the lowest amount of term to satisfy the MEC rules. So I don't have to pay for a lot of term costs. So they're setting up at 7 years or maybe 10 years because everybody wants this vanishing premium. Oh, look, you don't have to pay it past 7 years. Oh, look, you don't have to pay it past 10 years. The problem is I'm seeing this over and over where people are coming to us, even though our clients, what we may have set up for 10 years, because the 7 year hasn't been around very, very long, only since 2020. But now the 7 year people are coming and saying, you mean I can't put in the full amount because that's a material change for the modified endowment contract rules. The term leaves because it was only set up for 10 years or 20 years. Now you can still put the base premium in because that had nothing to do with the additional life insurance. But you can't put in any more paid up additional insurance without making the policy. And you can't add term to it because once the contract's established, you can't change the contract to enhance it. You can only change it to lower it. So this is becoming a real problem. And this, if you go back to Nelson, everybody says, well, Nelson needed to modernize his thinking, which is code for we want to make more money by selling you additional products. But Nelson would always say that you need to think long range. Why would you put in the few amount of premiums as possible if you're doing it for banking purposes? You're always going to be banking throughout your entire life. So why would you say, oh, I only want to do it for 7 years or 10 years or 20 years? So you think long range. Then Nelson says, don't be afraid to capitalize. Because Nelson said, did you ever hear a person say they had too much money in the bank? So if they said they didn't have too much money in the bank and you're using a different financial institution called an insurance company, could you have too much money in insurance? And they said, don't steal the peas. Okay, so if you're going to use the capital, replace it. Why wouldn't you want to replace it? Nelson used the grocery store example. If you owned your grocery store, would you just take the peas off the shelf and not replace them and hurt your own grocery store profits? Or would you replace them? And yet people are setting up banking at a bank they don't own. They can't steal the peas because they don't own it. So now they decide to set up their own whole life insurance for the process of banking. And then when they take loans against the policy, the collateral, the cash value, they don't pay it back. Well, you're stealing just like if you owned a bank and you weren't paying it back.
Mm-hmm.
And then don't do business with banks. That could be another episode talking about increasing the money supply, and then rethink your thinking. It is amazing how many people just do banking over and over somewhere else because we were conditioned to store money and take loans. And I always think this is really, people don't realize they're actually using the money you're storing in a bank to actually be able to give you a loan. Okay, so and then other people don't understand that all capital has a cost. So people say, well, I don't take a loan from the bank. I just pay for everything with cash. Well, you're still losing out on something. You're losing out on the ability to earn money on that money, which is called opportunity cost.
Hmm.
So all these things play a way of thinking in how policy design is. So I tell our clients that one, you will only do this through the human condition if it is easy. And then you have to overcome, but it's easier to overcome the human condition, behavioral things, if you understand how a contract works. And the best way to understand a contract is to keep it as simple as possible with as few possible changes in the future. And then people are able to overcome their behavioral aspects of it.
So to just put a capstone on this question, if somebody's asking, can you choose to get a level term or a annually renewable term within your whole life insurance contract? Is that an option that the consumer has, or is it an option that the insurance company places on the contract?
Not only can you the consumer do it, but different companies do it both ways. So some
Okay.
companies will only be a term insurance for a certain term, and they don't have any other products except that. Other companies will say, well, within our products, you can have a level term, not a 1 year renewable term, or you can choose the other one. There's even that one company out there that actually blends both of them in there, which
And
is
that's called
really
blended term, right?
no. What I mean is they will let you put a fixed term and a blended term on the same
Okay.
contract. It
Okay.
really gets confusing on that one.
So if you have the opportunity to choose, level term is going to be more effective. Is that correct?
Well, I wouldn't say it's going to. Let's not say it's going to be more effective because we don't know what the future is going to hold. But it brings in more certainty, and if it brings in more certainty, I believe most people will then move forward with actually taking the banking function into their lives because they'll understand it more easily.
Perfect. Okay. So hopefully we've answered and satisfied your questions and thoughts around term riders inside of a whole life insurance policy. If you have further questions, you can absolutely email them to us at hello@themoneyadvantage.com. You can also drop them into the comments section on wherever you are listening or watching this episode replay. And in closing, if you want to take action on making the infinite banking process and concept and strategy real in your life, you can do that by talking with our advisor team today. You can book a call at themoneyadvantage.com and we'd be happy to talk you through that in your own personal life and see what your financial picture will support. Now, in closing, please remember success leaves clues. So model the successful few, not the crowd.